TCS's number is expected around 5 p.m. today. Remember, the press conference is at 5:30, so we are expecting the number should be out around 5. The street is expecting a good set, at least in terms of the top line, because if you look at the rupee revenue growth, that is expected northwards of 4%. But dollar revenue growth is going to be a bit slower at around 1%, and that is because the cross-currency headwinds will eat into the revenue profile. Constant currency is expected at 3.2%, which is still quite solid. Though on a sequential basis, there would be a big slowdown because last quarter we saw the constant currency growth of 3.5%. The good news is that at least on the margin front there will be a sequential improvement. Now that's because there were wage hikes that were taken in Q1, and that's the reason we had seen that sharp margin dip. Having said that, despite the sequential improvement on a year-on-year basis, the margins will still be volatile, and in fact we are working with a number of around 23.8. The profit figure is expected to jump up by around 8%. In terms of the other internals, well, the deal win pipeline the management had indicated will be in the range of $7 to $9 billion per quarter. We are expecting the number to come towards the lower end of that range. And also in terms of the attrition and hiring trends, that will be important to track. The expectation is that the headcount addition will come off, in fact, materially this time around, given the headlines we have seen from the sector, and attrition is expected to remain sticky. However, having said all of that, the most important thing to watch out for will be the management commentary around it, whether there is a slowdown in terms of the client spend or not. European Union, which forms almost 30% of TCS's business, is seeing any impact or not. What about the BFSI and retail verticals? Is attrition going to remain sticky? Is margin going to be under pressure? And will the company be able to maintain its exit guidance for FY23 in terms of margin, which currently stands at 25%? So whether all of that will work out or not will be important, because the stock has corrected as much as 20% this year, and valuation wise it's much better than the peak of around 30-32 times that we had seen earlier. It's now down to 24 times, but still expensive when you look at the long-term averages. In fact, we spoke with Abhishek Bhandari to get a sense as to where he thinks the sector is headed and what should be the expectations from Q2. Listen out what Abhishek Bhandari from Nomura had to tell us.
Companies which have given salary increments in Q1 are likely to see a significant improvement in margins. Though I would say the pace of recovery of margins would be lower than the pre-COVID times, given that the attrition levels are still running high. In particular, in the large caps, we think TCS could have almost 100 basis points sequential improvement, and Infi could have around 60 basis points sequential improvement. Some of the mid caps where salary hikes were not given in Q1 and they have their hikes in Q2, they could see a downside of around 90 to 100 basis points, particularly in the likes of Mindtree and Persistent. But overall, I think the bottom of margin is largely made, though the pace of recovery of margins would be slow. Among the 3-4 subsectors of technology, which could see a lower spending from next year perspective, the technology spending, particularly in IT services, figure in top 4. So definitely there is going to be cuts in the budgets. There will be more priority given to making more returns out of the investment, particularly around cost optimization. And I think the pressures probably will be more in terms of consumer-facing sectors like retail and the interest rate-sensitive sectors like mortgages.